Forget what you think you know about Bitcoin cycles. Forget the charts you've memorized and the parabolic explosion everyone's waiting for. What if the blow off top is dead? What if it's not coming in this cycle and maybe not ever again? In this video, I'm going to lay out the evidence using on chain data and a deep dive into the new market structure that suggests the death of this explosive finale is the most bullish thing that could have happened to Bitcoin. What seems to be replacing it is bigger, more sustainable, and signals the beginning of a completely new era for this asset. So stick with me, because what the data is showing us could change the entire game. For years, we've been conditioned to see Bitcoin through the lens of past cycles. We look at a chart and see a ghost, the ghost of 2013, 2017, and the echo of 2021. We see a predictable rhythm, a pattern driven by the halving, and this pattern always promised one glorious, chaotic, grand finale, the blow off top. That face melting vertical ascent where the price goes completely parabolic and euphoria is so thick you can taste it. It's the moment legends are made of, and it's always been followed by its dark twin, the devastating, soul crushing 80% crash that washes it all away. This 4 year boom and bust has been our Bible. It's the map every investor has used. But what if that map now leads to a place that doesn't exist? There's a growing debate among analysts about whether this old cycle is broken. Some, like the CEO of Bitwise, argue the 4 year cycle is a pattern from a bygone era, killed by the forces of institutional adoption. Many people hear that and feel a sense of disappointment, like they've been robbed of their moonshot, but they might be missing the point. The potential death of the blow off top isn't the end of the bull run. It could be the end of Bitcoin's childhood. It's the start of its ascent into a true global asset, and this new phase may be infinitely more bullish than any single parabolic peak could ever be. Before we can understand why the game might be changing, we have to respect the old rules. The 4 year cycle wasn't just a theory. For over a decade, it was a shockingly reliable phenomenon etched into Bitcoin's code. At its heart was the halving, the event that happens roughly every 4 years, cutting the new supply of Bitcoin in half. This supply shock was the starting pistol for every major bull run. You could almost set your watch by its four emotionally charged phases. First was depression and accumulation, the brutal aftermath of the crash. The tourists were gone, the media declared Bitcoin dead for the 100th time, and only the believers were left, quietly stacking sats. This was the period of maximum financial opportunity, but also maximum psychological pain. Then, slowly, came the bull run. Fueled by the halving supply shock, the price would grind upwards, climbing a wall of worry. It would reclaim old highs, and whispers of a new cycle would begin. Smart money would be joined by early retail investors, and the narrative would shift from "is Bitcoin dead" to "how high can it go?" This led to the main event, the euphoria and the blow off top. This is the phase seared into our collective memory, pure, unadulterated mania. The price would detach from fundamentals and go vertical. We saw it in 2013 and again in late 2017 when Bitcoin screamed from under $5,000 to nearly $20,000 in months. This was driven by retail FOMO, fear of missing out. It wasn't driven by institutions, it was driven by human greed. And of course, the final phase was the crash and bear market. Once the last retail buyer was exhausted, the market would turn with shocking ferocity. An 80% or even 90% drawdown would follow, wiping out the get rich quick crowd. This crash was a direct consequence of the blow off top. The unsustainable, euphoric ascent created the conditions for an equally terrifying collapse. You couldn't have one without the other. Even the 2021 cycle, which felt different, was a variation on this theme. We got a choppy double top that confused many, but in hindsight, that strange price action was a warning. It was the first crack in the old model, hinting that new forces were at play, preventing that clean, retail driven explosion. It was the last gasp of the old world, because while we were all looking at the charts, a new player was entering the game, and they weren't playing by the old rules. So, if that was the blueprint, what ripped it up? The answer is a wall of money so large, patient, and strategic that it may have broken the old model, the institutionalization of Bitcoin. For years, the institutions are coming was a meme, but in 2024 and 2025, it became the market's dominant force. It all started with a green light from Washington, D.C. The approval of spot Bitcoin ETFs in January 2024 was a seismic shift. It wasn't just another product, it was a legitimacy machine. When firms like BlackRock and Fidelity put their name behind Bitcoin, they signaled to the financial world that Bitcoin is an investable part of the global system. This shift was accelerated by a changing regulatory tone. In January 2025, the SEC rescinded its controversial Staff Accounting Bulletin 121, or SAB 121, a rule that made it difficult for banks to custody crypto for clients. This move, following bipartisan efforts to overturn the rule, opened the floodgates for more traditional financial players to get involved. This has introduced a new type of buyer with a different psychology. Think of it as tourist capital versus permanent capital. Tourist capital is the retail FOMO that drove past blow off tops. These investors rush in during hype, look for quick profits, and are the first to panic sell, fueling those massive crashes. Permanent capital is different. This is institutional money from pension funds, corporate treasuries, and sovereign wealth funds. They aren't gamblers trying to time the top. They are fiduciaries making long term strategic allocations. They are buying Bitcoin as a hedge against currency debasement and a diversifier for their portfolios. And the scale is staggering. The conversation has now turned toward including Bitcoin ETFs in 401k retirement plans. While widespread adoption is still in its early stages, some analysts believe even a small 1% allocation from the trillions in US retirement accounts could represent a massive wave of new systematic demand. We're also seeing governments get involved, like the state of Texas, which recently purchased shares in BlackRock's IBIT for its strategic reserve. This creates a fundamental shift. Instead of a market dominated by fickle retail sentiment, we now have a massive price insensitive bid side support. These institutions aren't trying to sell the top. In fact, they often use dips to fill their allocation targets. This patient, deep pocketed demand acts as a shock absorber, taming the wild volatility that once defined Bitcoin. They are a floor, a permanent bid that never existed before, and their presence may have completely dismantled the structure that created the blow off top and its subsequent crash. But don't just take my word for it. The proof, as always, is transparently recorded on the blockchain. And the on chain data this cycle tells a radically different story. Let's start with holder behavior. In previous cycles, the path to the top was paved by long term holders selling to new speculative retail investors. Metrics like the ASOPR, adjusted spent output profit ratio, which tracks profit taking, would spike into a euphoria zone. This cycle, those indicators have been much more contained, suggesting the market has not yet hit that final manic phase of profit taking. On chain analysts have noted a different pattern. Old whales seem to be selling not to weak handed speculators, but to new, long term whales like the ETFs who have even stronger conviction. Next is historically low exchange balances. The amount of Bitcoin available on exchanges has been in a long term downtrend and is hovering near historic lows. The coins are being bought and immediately moved into cold storage, the digital vaults of ETFs and institutional custodians. They are being taken off the market with the intention of holding them for years. This creates an ever dwindling pool of available supply, a supply shock met by a demand shock from institutions. Third, let's look at volatility. For years, Bitcoin's Achilles heel was its insane volatility. Post ETF, however, we've seen a noticeable taming of Bitcoin's violent nature. One analysis estimated that average daily volatility has dropped significantly from an average of 4.2% in the pre ETF era to 1.8% in the post ETF era. While the market can still have sharp moves, the overall trend points toward maturation. This reduction in volatility is what makes Bitcoin a more palatable asset for risk averse managers of trillion-dollar funds. They aren't looking for a roller coaster, they're looking for a reliable store of value. Finally, the nature of whale activity has evolved. In the old days, a whale was an anonymous early adopter who could crash the market. Today, the biggest whales are no longer anonymous. They are publicly traded ETFs like BlackRock's IBIT, which held over 776,000 BCT as of late November 2025. Soon, they will be sovereign nations. Their accumulation isn't secret, it's public. This makes the market far more transparent and predictable. When you put this evidence together, the conclusion seems clear. The market may no longer be built for a retail-driven blow-off top. The buyers are different, their motivations are different, and their impact is permanent. The very DNA of the Bitcoin market appears to have been rewritten. All right, we're going deep here, and I know this is a lot to take in. We're questioning a model that has defined this space for a decade. But if you're getting value from this analysis, and if it's helping you see the bigger picture, do me a favor and hit that subscribe button and turn on notifications. It helps the channel immensely, and you won't want to miss what's coming next. Because now we get to the most important part, why this new world might be so much better than the old one. Okay, so let's say the blow off top is dead. The wild party we were expecting has been canceled. To many, that sounds like terrible news. But this is where you need to shift your perspective. The potential death of the blow off top isn't a tragedy. It could be the single most bullish development in Bitcoin's history. First, by killing the blow off top, we may have also killed its evil twin, the 80% crash. The two were a package deal. The parabolic, unsustainable rise was the only reason we had to endure those soul crushing multi year bear markets. That extreme volatility was a massive barrier to entry for serious capital. No pension fund manager or corporate treasurer could responsibly allocate to something that could lose 80% of its value in a year. The absence of that blow off top would signal the maturity thesis. Bitcoin is graduating. It's shedding its skin as a speculative gambling instrument and stepping into its final form, a mature global store of value, a digital gold. Think of it like a risky penny stock evolving into a reliable blue chip stock. The penny stock might give you a thrilling 1000% pump followed by a 95% crash. The blue chip stock grinds up year after year. You don't get the insane spikes, but you also don't get the catastrophic collapses. You get sustainable wealth creation. This is the transition Bitcoin appears to be making. The institutions are here for the digital blue chip. A steadier, less volatile, and more predictable climb is precisely what makes Bitcoin more attractive to the largest pools of capital, not less. A calmer market is a bigger market. This brings us to a new potential model for price action, what some are calling the stair-step ascent. Forget the rocket ship. The new picture is a powerful climber ascending a massive mountain, one steady step at a time. In this paradigm, we'd still see strong upward movements. But instead of one parabolic run, the bull market would be a series of thrusts upward, followed by healthier, shorter, and much less severe consolidations. Instead of 80% crashes, we might see 20 to 30% pullbacks. These pullbacks wouldn't be bear markets. They'd be opportunities for the next wave of institutional capital to enter. Each step up would create a new, higher price floor, defended by those patient, deep pocketed institutional buyers. This new model of a steadier ascent would fundamentally improve Bitcoin's core function. An asset that crashes by 80% is a poor store of value, but an asset that reliably appreciates with manageable volatility becomes the world's best savings technology. It becomes a true hedge against fiat currency debasement. Its utility as digital gold is massively enhanced by this newfound stability. So when you see the market moving sideways, don't mourn the blow off top that isn't happening. See it as a sign of a healthy, maturing market. The death of the blow off top isn't a bug, it's a feature. It is the necessary sacrifice for Bitcoin to attract the tens of trillions of dollars waiting for a mature store of value to emerge. So here's the big question. If the old cycle models are broken, how do we forecast the price? If we can't just rely on past cycle tops, what do we use? The answer is to shift our focus from timing models to the new driver, supply and demand dynamics. The timing is no longer dictated by the halving clock alone, it's now dictated by the pace of institutional adoption. The new model is simpler. On the supply side, we have a fixed quantity and a growing portion being locked away by long term holders and ETFs. On the demand side, we have a tsunami of new capital entering the market. Therefore, price prediction becomes less about timing a peak and more about modeling the flow of funds. Given the ongoing adoption trends, many analysts are still forecasting significant price appreciation. JP Morgan, for example, has suggested a long-term potential of $240,000 as Bitcoin's market structure changes, with shorter-term targets around $170,000. Other analysts and models point to a bull peak for this cycle in the $150,000 to $200,000 range, but the key difference is that these numbers may not be a final top. They could be milestones on a longer journey. Reaching $200,000 in this new paradigm would likely be followed by a healthy consolidation, perhaps back to $150,000 as the market builds a new base before the next stair step upwards. So my prediction isn't a specific price on a specific date. My prediction is about the character of the market. The era of the blow off top may be over. The era of the stair step ascent may have begun. Stop trying to time the top and start thinking in terms of long-term accumulation, because the game has fundamentally and bullishly changed. We are at a pivotal moment in Bitcoin's history. For 12 years, we lived in a world of predictable, violent cycles, all ending in a euphoric blow off top and a devastating crash. That world may be gone. The tidal wave of institutional capital, unleashed by regulatory clarity and ETFs, seems to have drowned the old cycle. The blow off top may be dead. And this is not a eulogy, it is a celebration. The potential death of this speculative frenzy could mark the birth of Bitcoin as a mature global asset. It signals a transition from a market driven by retail FOMO to one anchored by the patient capital of the world's largest financial institutions. This new paradigm promises a future of more sustainable growth and shallower corrections. It replaces the roller coaster with a steady, powerful climb, the stair-step ascent. This newfound stability is the feature that could unlock trillions in new investment and solidify Bitcoin's role as the premier store of value for the 21st century. The game has changed and the new rules are infinitely more bullish. But that's my analysis. I've laid out the data and the thesis. Now, I want to know what you think. Do you agree that the game has changed? Are you still holding out hope for one last epic blow off top? Or are you preparing for this new reality? Let me know your thoughts in the comments below. Thanks for watching.